Okay, there are five general guidelines that we use in order to classify leases. Under the old standard with US GAAP, these guidelines, actually there were only four guidelines before, and they were very bright line rules. Under the new standard, they're not really bright line rules as much anymore, but we'll talk about sort of how they're applied in practice. So again, as I just said, US GAAP no longer applies these criteria as bright line rules. The five guidelines that we're going to talk about are typically applied as rules, even though, and also should generally be followed, but again, they aren't as sort of black and white as they were before. We use these criteria to determine if it is a finance lease. Before considering each criterion individually, the lease must be non-cancelable. If the lease is cancelable, then it should be treated as an operating lease. So the first guideline is transfer of ownership, and basically if the ownership of the right of use of asset transfers to the lessee at the end of the lease, then it should be treated as a finance lease. Also, when we talk about the purchasing option, if it's reasonably certain that the lessee will exercise a purchase option at the end of the lease, then the lease should be treated as a finance lease. And so what does it mean to be reasonably certain? In practice, if the option price is substantially below the projected residual value of the right of use asset, then it is reasonably certain the lessee will exercise that option. Sometimes this is called a bargain purchase price. Again, this idea of reasonably certain does leave some room for judgment. The third test is what's known as the lease term test. Sometimes it's commonly known as the 75% test. So if the lease term is 75% or more of the estimated remaining useful life of the right of use asset, then it is a finance lease. So how do you handle any renewal option periods? So a lot of times lease might include renewal options. And so under current standards, FASB states that if it's reasonably certain the lessee will exercise the renewal option, again, the idea here is if the renewal is a bargain, then the renewal period must be included in the lease life. There may be challenges in estimating the remaining useful life of certain assets, but in most cases that remaining life can be readily known. The fourth test is the present value test, sometimes known as the 90% test. So if the present value of the minimum lease payments equals or exceeds 90% of the fair value of the right of use asset, then it should be treated as a finance lease. Two important points. First of all, you have to determine the minimum lease payments, and second of all, you do need to calculate the implicit discount rate in the lease. So with the minimum lease payments, you include all of the following. If there are fixed payments, usually that's easily found in the contract. You may also include variable payments that are based on an index or rate when they are known. And then the amounts, any amounts that are guaranteed by the lessee under a residual value guarantee should also be included. And then finally, if there are payments related to the purchase or termination of the lease, again, the idea here, if it's reasonably certain that these payments will be made, then they should also be included in the minimum lease payment calculation. Secondly, we do have to think about the discount rate. The lessee should use the implicit rate in the lease, which is basically that lessor's rate of return in the lease. And if the implicit rate cannot be determined, then the lessee may use its incremental borrowing rate. The final test is called the alternative use test. And so if at the end of the lease term the lessor does not have an alternative use for the asset, then it should be treated as a finance lease.